What is material? Material refers to all commodities or physical objects used to produce a final product. It is classified into two types: direct and indirect. Direct material, materials that can be directly attributed to the final product, such as wood for furniture or cotton for textiles. Indirect material, materials that support production but are not directly part of the final product, like lubricants for machinery or cleaning supplies. Let's take an example of wooden chair to understand little more. So here wood and paint comes under direct material, because they become an integral part of the final product, and their cost can be directly traced to each unit produced. Here paint is used for finishing and protection, becoming a visible part of the final chair. Since every chair requires a certain amount of paint, its cost is directly linked to each unit. Materials that physically form part of the final product and can be measured per unit are considered direct materials. To assemble a wooden chair, nails and a hammer are used to join the parts, while sandpaper helps give it a smooth finish. These materials are classified as indirect materials because they support the production process but do not form a direct part of the final product, since their cost is not easily traceable to each chair individual. In this chapter, we will learn valuation of material receipts, inventory control, techniques, inventory stockout, valuation of material issues. Let's come to our first topic. Valuation of material receipts means ascertainment of cost of material purchased. For example, Clare Company buys wood to manufacture chairs. Since it purchases in bulk, the supplier offers discounts. To transport the wood to its factory, the company pays for delivery, which may include toll taxes and GST. The final cost of the wood includes the purchase price, discounts, and transportation costs, forming the total material cost for production. Now we will see how statement of cost of material looks like. The cost of material includes all expenses necessary to bring and make it available for production, and subtract all those items which reduces the cost at that time from cost of purchase. These deductions help determine the net material cost used in production. Now, pause and read the items given in the table. There are some special items which does not form part of cost of purchase and hence ignored. Cash discount, it is treated as interest and finance item, therefore not to be deducted in cost of purchase. Penalties or charges, penalty of any type should not be included. It is treated as abnormal loss. Penalties such as demurrage is imposed by transporter for delay in uploading or offloading. Detention charges or fine imposed for non-compliance of rule or law by any statutory body. In penalty we talked about abnormal loss. What is it? Let's understand. We have two types of losses, normal and abnormal. A natural and unavoidable loss in production, like evaporation or breakage, expected under normal conditions, are normal loss. An unexpected and avoidable loss due to accidents, defects, or inefficiencies, considered an extra expense, are abnormal loss. Shortage due to normal reasons will considered part of cost of material and therefore be deducted from it. Shortage due to abnormal reasons are debited to costing profit and loss account. It does not form part of cost of purchases. Now, let's talk about GST and the cost of containers. If the containers are non-refundable, they will be added to the cost of purchases. Refundable containers do not form a part of the cost. In GST, if the input tax credit is available, it will not be added to the cost and will be ignored. If the input tax credit is not available, only then will it be added to the cost of purchases. Every item that does not form part of the cost of purchases must be shown in the notes of your answer. In this chapter, we talk about direct materials only. Our next topic is inventory controls. Inventory control ensures businesses maintain the right stock levels to avoid shortages or excess inventory. Management may adopt the following basis for inventory control. First, we talk about quantitative levels. Let's understand this by chart. In the previous example, Clare Company purchased wood in bulk at a discounted price. To transport the inventory to their warehouse, they paid freight charges and toll taxes, which are classified as ordering costs. Once the inventory arrived at the warehouse, Claire Company incurred additional carrying costs to store and manage the stock. These carrying costs include storage costs, expenses for renting or maintaining warehouse space; insurance costs, coverage for inventory protection against damage or theft; handling costs, labor expenses for moving and organizing stock; ordering cost, the expenses incurred to purchase and transport inventory to the warehouse, including freight, toll taxes, and supplier communication costs; carrying cost, the ongoing expenses of holding inventory, such as storage, insurance, depreciation, and handling costs. Claire Company's inventory challenge. Claire Company makes wooden chairs. Business was running fine until one day, problems started showing up. First, their stock ran out unexpectedly. Production stopped. Customers were frustrated. Orders were delayed. So Claire asked, how can we prevent stockouts? The company found the solution, reorder level, ROL, at 400 bundles. Now, whenever stock drops to 400, a new order is placed. Next, another issue, too much stock. Claire ordered extra to avoid shortages. But now, storage costs were too high. So they asked, how much stock should we keep? To solve this, they set a maximum stock level of 800 bundles. Means that the total inventory in the warehouse should not exceed this limit. Then came another concern, what if they run too low on stock? They asked, what's the minimum we need? To stay safe, they set a minimum stock level of 200 bundles. This ensured they always had enough for basic operations. Claire Company initially set a reorder quantity, ROQ, of 350 bundles, ordering this amount every time stock dropped to 400 bundles, reorder level. But soon, they noticed a problem. Ordering 350 bundles each time wasn't necessarily cost-efficient, leading to higher storage expenses. So they asked, what's the best order quantity to minimize costs? The answer? Economic order quantity, EOQ, of 300 bundles. An economic order quantity, EOQ, is the optimal order quantity that minimizes total inventory costs by balancing ordering costs and carrying costs. It ensures businesses order the right amount to meet demand while avoiding excess storage expenses. To further optimize inventory management, Claire adjusted their reorder quantity, ROQ, to 300 bundles instead of 350, now matching their EOQ, ensuring cost efficiency and consistent replenishment. But what about unexpected demand? Some months, sales suddenly increased, causing shortages again. They asked, what if we need extra stock unexpectedly? To fix this, Claire kept buffer stock of 100 bundles for emergencies. Finally, Claire needed balance. Stock was fluctuating too much. So they asked, what's the ideal stock level? The answer was an average stock level of 500 bundles. A steady flow of inventory for smooth production. Just when things seemed perfect, Claire faced a final issue. Orders weren't arriving immediately after placement. They asked, why does it take time for our order to reach us? That's when they understood lead time, the time taken between placing an order and receiving materials. Wood suppliers needed 7 days to deliver. So Claire adjusted inventory planning, ensuring orders were placed in advance. Now, Claire Company's inventory is perfectly managed. No more stockouts. No more excess storage costs. Just smooth production and happy customers. From the following picture, you get to know ROL, ROQ, when to use them, and their answers. But how did Claire Company determine those numbers? For that purpose, they used inventory management formulas. Pause and read. The formula for average inventory stock level is also used to calculate the total carrying cost, which we will discuss later. Let's deep dive into EOQ. Here, A represents annual demand, O stands for ordering cost per order, and C refers to carrying cost per unit per annum. To determine EOQ, we input the given information into the formula. If we divide total annual demand by the EOQ, we get the number of times we need to order, which is the total number of orders. Thus, total ordering cost is equal to number of orders multiplied by ordering cost. To find total carrying cost, we first calculate the average stock level using the formula, or we can say half of EOQ, then multiply it by the carrying cost per unit per annum, C. In EOQ, total ordering cost and total carrying cost are equal, ensuring cost efficiency. Let's jump to the inventory control using ratio analysis. Every business relies on inventory, but managing it efficiently can make or break success. That's where inventory turnover ratio comes in. It tells us how quickly a company sells and replenishes its stock over time. The formula is simple. Inventory turnover ratio equals cost of goods sold divided by average inventory. A high turnover ratio means inventory is selling quickly, keeping cash flowing and storage costs low. A low turnover ratio, however, might indicate slow sales, overstocking, or poor forecasting. Businesses optimize turnover by managing stock levels, forecasting demand, and ensuring timely replenishment. Understanding this ratio helps companies make smart inventory decisions, keeping operations smooth and customers happy. Inventory holding period measures how long a company keeps inventory before selling it, impacting cash flow and storage costs.
In Part 2, we'll solve the questions based on the concepts covered in this video and dive into ABC analysis and valuation of material issues. We'll work through ICAI module questions to solidify our understanding. In Part 3, we'll tackle FIFO, RTP, and MTP questions for thorough exam preparation. Then, in Part 4, we'll focus on case-based scenario MCQs to sharpen our problem-solving skills. Stay tuned.